Hello everyone, in this session we'll keep working with the income statement. We looked at the purpose of the income statement, the limitation, and we looked at the elements of the income statement in the prior recording, which is critical: revenues, expenses, gains, and losses. In this session we're going to look at additional elements, and the reason I list them separately, I could have covered them in the prior session, because by their nature they are called unusual and or infrequent gains and losses. We talked about gains and losses, but those are a little bit unusual, or they are infrequent. They don't happen very often. Believe it or not, 10 years ago, those were treated differently. I am not going to explain why or how. We're today. Now they are part of gains and losses. It's easier to deal with them. Nevertheless, I still think I need to list them separately, explain them because they are unusual or infrequent. Also in this session, I will cover something called the non-controlling, or also known as the minority interest that goes on the income statement. So basically what we're doing is we're going through the income statement, and we'll have one session to go, discontinued operation. As I always mention, if you're an accounting student, CPA candidate, CMA candidate, being comfortable and familiar with the income statement is critical for your success. It's critical for your career success. The income statement is a basic financial statement that we all need to be familiar with. Let's go ahead and learn about unusual and or infrequent gains and losses. Let's get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So let's dive deeper into the unusual and or infrequent gains and losses. Let's look at the definition for them first. What is unusual gains and losses? Well, gains and losses that don't usually occur on a day-to-day basis. As I mentioned, those are gains and losses. We could have gains and losses, for example, from selling our own investment. We could have an investment, we could have a gain, we could have a loss. Well, that's fine, but we could have some unusual gain and losses that don't really belong to our business environment. What are they? We're going to look at some examples. I just want you to kind of get to the idea where it's unusual in a sense that it doesn't usually happen. Unusual, if you want to add infrequent, means it's not expected to reoccur. So given what we do, given our environment, we don't usually expect this gain or loss to occur. Again, the best way to kind of know what they are is to look at some examples, because GAAP do give you some examples because you want to know, because they are unusual, infrequent. But again, they are unusual and infrequent in relationship to your business environment. And I will emphasize this point later on once we look at some examples, in a sense why they are unusual and or infrequent. As I mentioned earlier, those are listed with other revenues and gains, other expenses and losses. However, they are a little bit unusual. I also want to emphasize one more point about unusual gains and losses and infrequent before I discuss examples, is how they are reported for tax issues. For tax purposes, these losses and gains are reported at gross of tax. There's no such thing gross of tax. The point I'm trying to make is they are not reported net of tax. They are not reported net of tax. And if you don't know what net of tax is, don't worry. We're going to see what net of tax is in the next session. The point I am trying to make is those gains and losses are reported. The point is before taxes. After they are reported, we apply income tax to them, whether they are deduction losses or we have to pay taxes on them if they are gain. So they are reported before tax or gross of tax. Again, there's no such thing gross of tax. The reason I'm using this term is to make the point that they are not reported after we take the tax effect. They used to, but again, as I mentioned, I am not going to discuss anything from the past. Now, the best way to know what these items are is to look at some examples of unusual or infrequent gains and losses. What could be some examples? Well, gains and losses from abandonment of property, plant, and equipment. If you abandon property, plant, and equipment, that should not be something that you do on a regular basis. I mean, it is, you can sell. That's normal to sell your property, plant, and equipment, incur a gain or a loss. Maybe you want to trade it, you incur a gain or a loss. But just to abandon it, to let it go, that's not usual. Therefore, abandonment, it means just let it go, just leave it where it is. That's not usual. Employee strike. Well, if we operate a business, we don't expect our employees to go on strike on a regular basis. And this is usually a loss, by the way, if it's an employee strike. Natural disasters, floods and earthquake. Assuming you operate in an environment where floods and earthquake are not normal reoccurring event. Now, in some areas, floods and earthquake could be normal reoccurring event, depending on the geographical areas. But if you incur any gains or losses, you might be saying, how would you incur gains from floods and earthquake? Well, in case the insurance reimburse you and they reimburse you more than the book value, you could have a gain or a loss. So would always floods and earthquake will be unusual gains and losses and or infrequent? Well, it depends on your environment. If this question is given on the CPA exam, you will be told that's not usual for the business environment. Or they could tell you this happened on a regular basis, therefore it's not unusual or infrequent. But the point, this is a good example where giving the business context depending whether it's unusual or infrequent. Once again, I'm making a big deal out of those items, and there's no need to, because as I told you, they are reported with other gains and losses, other expenses and losses, and other gains and revenues. I just want to emphasize them because in the past they used to be treated differently. Impairment of receivable, that's, they're simply put, they are reported with non-operating. Remember, we have the operating and non-operating. They are reported with the non-operating. Impairment of receivable, property, plant, and equipment, and goodwill, non-operating. Restructuring charges, non-operating. We call them unusual gain and losses. Nevertheless, they are treated just like any other gains and losses. Gains and losses as a result of retirement of debt. This is usually, they trick you this on the exam. They want you to think of retirement of debt as something, something that needs to be reported net of tax, or it should not be reported with other gains of losses. That's normal. All of these are reported with other revenues and gains, other expenses and losses. Now, having said so, let me go back through the income statement one more time. I just want to go back through the income statement. Remember, we have revenues minus cost of goods sold will give us gross profit. Then we have operating expenses. We have selling and administrative. We add up all the selling, we add up all the administrative, we take gross profit minus all the expenses will give us income from operation. Remember, this is the operating section, and this is the most important. You want to look at income from operation. Then we have non-operating things, and this is where these unusual and or infrequent gain and losses are listed with the non-operating. Now, what else are we responsible for? Something called non-controlling interest and income. So the income statement, this is not complete. We have more items that could be listed there. Something called non-controlling interest. Now we need to know first, what is non-controlling interest? Well, non-controlling interest is when one company buys another company. So when one company buys another company, they can buy 100% of that company. Usually that does not happen. Why? Because even if they want to buy 100%, you might find 1%, 2%, 3% or 40% of the shareholders, they don't want to give up their ownership. They want to keep their stock. Well, guess what? Those shareholders, they have non-controlling, used to be called minority interests. Now they call it non-controlling interests. Because once you own more than 50% of any particular company, you have controlling. So once you own more than 50% of a company, and you would learn this in your advanced accounting, you control that company. And if you control that company, you have to consolidate 100%. So if you only own 51%, you consolidate 100%. It means you take all the revenues, all the expenses, everything. You take everything and you consolidate it, although you own 51%. Now, you don't own the whole thing, but you consolidate 100%. So what do you have to do? On the income statement, you have to make an adjustment. You have to deduct the non-controlling interest income. it's basically you have to take it out, back it out, because you don't really own it. If you own 51, there's 49% you don't own, but you consolidated 100%. Therefore, you have to deduct that 49%. So it's the portion of equity, which is net asset, including income, and a subsidiary does not belong to the parent company. So the best way is to show you an example. Assume that Adam acquires 60% of the outstanding stock of Ryan Company. Because Adam owns more than 50%, Adam would consolidate 100% of Ryan's company. Now, GAAP requires that net income to be allocated to the controlling and non-controlling interest, because although you own 100%, you consolidate 100%, you own 60. It means 40% you don't own. So how do you show this when you consolidate? When you consolidate, you prepare your income statement, and in revenues, you would include the 1 million that Ryan earned. Then, since you don't own 40% of that, toward the end of the income statement, you put less net income attributable to the non-controlling interest, less 400,000. And this is what we meant by non-controlling interest. You back out the income that does not belong to Adam. Adam is the parent company. Yes, they control the company 100%, but they don't control, they control it, but they don't, there's still a group of people, 40%, that did not give up their ownership. Therefore, we have to deduct their net income out of the consolidated income. So this 400,000 is the minority or the non-controlling interest. What do we do with that? We'll deduct their income on the income statement. Then we come up to net income attributable to stockholders of Adam Company, which is 2.6 million. We assume the net income is 3 million. So of the 1 million, just let me show you 1 million here. We consolidated 100% of it. We don't own 100% of the company. We own only 60. Therefore, we have to deduct from that 1 million 400,000, and this is where we show that deduction of 400,000. So basically, what's left, what we included from Ryan's company, is 600,000. This topic is heavily covered in advanced accounting. So you need to know about non-controlling interest consolidation later on, much more. This is just scratching the surface. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, look at true-false questions, additional resources that's going to help you whether you are a CPA candidate or an accounting student. Invest in yourself. I do have AI CPA exam questions. Invest in yourself. Good luck, study hard, and of course, stay safe.